What's going on, everyone? Today we're going to be talking about mortgage tips and tricks. Have a budget. A budget's going to be super important when you're going into this process because when you get pre-approved, there's two different ways to do it. One, we can pre-approve you for the max amount that you can afford, or we can pre-approve you for a budget, a payment that you want and can make every month. You may qualify for a $500,000 house but only want to spend $2,000 a month. If you go in blind, don't have a budget, and say I want to qualify for the maximum amount, you're going to be shopping for homes outside of your monthly price range, and you're realistically not going to be doing yourself any favors. Get pre-approved, right? Don't just go out to a realtor and say, hey, I think I qualify for this much house, go ahead and start showing me houses. Most of the times the realtor is going to send you to their preferred lender in order to get that pre-approval. It's always best to walk in already pre-approved, knowing exactly what you can afford or how much home you can qualify for. Discuss your options. When working with an independent mortgage broker, they don't just have a single set of loan options available with a certain rate sheet. They are able to use shop multiple different lenders with multiple different loan programs and interest rates. You may qualify for an FHA loan or a 3% down first-time homebuyer loan, or possibly VA if you have any military history, or USDA depending on where you're purchasing. Maybe you want to build a home from scratch with a new construction loan, or maybe you're just looking to take out a home equity line of credit on your current property. Make sure you're discussing your options with a mortgage professional. Is shop with multiple lenders. Find which products and which rates are going to make the most sense for your individual scenario. No mortgage is the same as another. So your budget may be different. Your available assets for down payment and closing costs may be different. Your credit may not be the best. It may be fantastic. Make sure you are shopping with multiple lenders and getting multiple quotes. This is a big no-no. No major purchases or new credit card debt. When qualifying for a mortgage, we are going to calculate what's called your debt to income ratio, DTI. What this is a breakdown of your monthly income and your monthly outgoing debt. If you, say, deplete your assets with a major purchase, or add $4,000 in new credit card debt, that is going to increase your monthly outgoing debt, which will overall increase your debt to income ratio. We want to keep you under 50% DTI as a ballpark area. The lower you are, the better. Do not quit your job. Now, you may think that this is a pretty obvious one, but jumping back to that debt to income we discussed in the last segment, if you quit your job, you no longer have income and you are all outgoing debt. You will not be able to afford a home. No job, no house.